Of course, the S&P pacing for the fourth down week and the longest losing streak since March. A lot has been made, guys, about, we're 3 weeks into the war in the Middle East. The S&P hasn't moved that much, considering all the geopolitical headlines that we have been seeing. What do you think is the reason for that? And do you think that there is something that would create a bigger drawdown in the S&P?
Yeah, I want to see how we come out of the weekend or finish the week here with the triple witching. I'd like to see the market hold ground, not really extend itself below the 200-day moving average that we broke yesterday. The Qs also closed below the 200-day moving average. There's a lot going on with the money flows, and I think that's really what one of the big issues is here. And the war, the Hormuz blockage, it's really moved. It's put a halt on money flows, and I think that's on top of the private credit fears, is compounded things right now. Now, I do think that there is some things to hang your hat on. I mean, there's been good earnings. About 73% were beats. Information technology stood out. Energy has stood out. We're overweight energy in our portfolios, and I like that. And really, at the end of the day, it's going to continue to be a stock picker's market. I know that sounds cliche, but there's names that have been just bludgeoned this year that have brought out some opportunity at this point. But there's also names that some downside risk across the market broadly and sectors if things that we're seeing right now with the war and the money flows persist.
Yeah, and energy, the key bright spot in today's market, that sector up about 1.1%. And Steve, I'm curious, so we've talked a lot about geopolitics, a lot about the private credit fears, and then there's also some tightening happening. And we were expecting a slew of rate cuts. Now, at least in the market, it's pricing in, potentially even a hike at this point in time, as you have the backdrop of fears about inflation, oil, and what geopolitics could do there. What do you make of that notion, and do you think that the equity market is reacting, in sympathy with that?
First, I want to go back to your first question you asked, Bill, where you say that the market's not off, the S&P's not off that much. And that's great if you're an index investor only. But if you're a stock investor, depending upon your portfolio, there's been significant carnage, correction territory, and even more. So you can take a look at some of the larger cap tech names. There's Meta that's down significantly. Caterpillar's down significantly. Now, Caterpillar was at, arguably, and I said this before, maybe overvalued, but it would grow into the valuation. The point is that narrative doesn't apply if you invest in stocks, because there's been real carnage there. Now, going to your question now, if you look at when the market's had big moves, it's been because of global easing, right? Accommodative monetary policy everywhere. Now we're looking at the other way. So there's some real concerns here. If you take a look at what's happened to the yield curve, we're seeing a flattening of it. So look, you can use stagflation, which I've been talking about for a few weeks, as a possibility. That'd be really scary for the market. That would be when you're losing jobs and inflation keeps going. So the Fed's sort of frozen because they can't help you on the job side by cutting rates because you've got inflation. So inflation is a real concern. The longer this goes on in terms of Strait of Hormuz closed, then the worse it's going to get. So the volatility, which I think we'd all been expecting coming into the market, now is decidedly a downward skew. So I still don't see why you'd want to put money in here into the market at these levels. And I've been consistent with that because it's catching a falling knife. So I just say this. So where, the not getting short had been the right thing to do, because while the war was going on, because at any moment in time, Trump can declare victory and say, we're done pulling out. Now with the Strait of Hormuz, it has another complication. And that complication is not just opening the strait, but still leaving Iran in a position where they can do this again.
Right.
So until you really eradicate the threat for all future times, for now and beyond, you really can't pull out. So that keeps us there longer. It may put boots on the ground, and none of that is good for the market.
Well, it's interesting, Bryn, because Pippa Stevens was on last hour, and she was saying that the futures market is implying, at least for oil, that this war won't last very long, that it's actually trading $20 below today's prices for crude. So how do you think about the various markets and the likelihood of a protracted war in the Middle East, which is something that actually David Solomon addressed in his annual shareholder letter today as it pertains to what it means for deal activity? There's just so much up in the air with regard to the war and what it means for various markets. Which one do you put the most stock into in terms of its likelihood of predicting the length of this war?
Well, I think we have all eyes are on oil prices. And so, I think oil prices, whether it's in the future spot or today, they're incredibly elevated than where they were 3 months ago. And so as we're trying to, in the U.S., have rates come down, as we're trying to get rate cuts, keep the economy strong, right now we're getting the opposite with yields, like the 10-year almost at 440. You would think with a flight to safety, you would have yields falling, but because of these inflationary fears, yields are going higher. And so, to me, the big catalyst is oil prices, which, to Steve's point on Iran, this is not Venezuela. This is Iran. I think this is existential for the leadership in Iran. They don't seem to want to go away. A new person continues to pop up. And so I do think this is here with us for a while. In terms of the markets, the U.S. can obviously handle this exponentially better than any other country because we have so much oil and natural gas just domestically. And so when it comes down to the global impact, I think that's why you'll continue to see emerging markets, international come down, because we know they're much more sensitive. They're all importers of oil because they said they were bad and we're going to go do windmills and solar panels, which don't really work, as we're seeing. And so I just think the jury's still out. I will say, there's a good adage, nothing good happens under the 200-day. And with the NASDAQ and the S&P both just slightly below that, we really do need to catch a bid there, because I just think that puts that technical pressure where you're just going to have this continued pressure of how far do we go under the 200-day. So I think the volatility is here to stay, and it looks like oil prices are here to stay higher as well, which is not positive for the markets in the short term.
Yeah, technical elements, fundamental elements. Bill, I'm curious, what's a safe haven play in this environment? Obviously, investors don't like bonds. Gold is selling off here. Is there a place where you can kind of feel protected in this environment?
Yeah, metals have had a really tough week, and that's part of the where when global trade is taking place, where assets are getting parked, and there's been a push away from using the U.S. assets, U.S. as a place to park those assets amid the trade. Now the trade that has pushed it towards gold, and we've seen the trade really tighten. We're not seeing anything happen with passage to the Straits of Hormuz. So gold has been selling off really sharply. I still like the case for gold. There's some technical damage there, but really it's come to an old-fashioned just cash at the moment. If because I think if you have cash, opportunity is going to present itself. And in a time like this, we're not overweight cash from the way we look at it. We have about 4.5% cash in our main portfolios. Typically, with some of this going on, we would have closer to 8 to 10% cash, but we've used, and that's where we were about a month ago. We used that cash to buy software at levels lower than where it is now, like ServiceNow, CrowdStrike, Microsoft, Oracle. And so I think there's opportunity that's going to present itself. And I think having cash over the next couple of months, you're going to find those opportunities. And that might really be the best way to be parking it at the moment, because there is risk in bonds. And we keep our duration around 5 years, not more than 7, because there is risk in the inflationary environment. If inflation, we saw the PPI data. We've seen what the CPI is sort of bubbling a little bit, and if we continue to see the global trade locked up and supply chain disruptions, inflation is going to continue to pick up, and that's going to hurt your bond portfolio. So right now, it may just be cash being the best place to park your money.
Steve, you mentioned stagflation, the S word.
Yep.
And I'm curious, against that backdrop, how much further does the market need to fall for it to be a buying opportunity en masse? I ask this because Bank of America's Michael Hartnett writing, global markets need to fall another 3 to 5% to trigger a big buy. Do you think it needs to fall more than that, or does that make sense to you?
Again, I don't know what that means, global markets, because I'm a stock investor, right? If I hedge, or like right now I'm hedged with some Qs, nowhere near enough short some Qs, but to me, I just don't know what to do. I don't know what to do with a statement like that, right? So, and when it's safe to buy really depends upon your time frame. So there's no doubt in my mind if you buy, or little doubt in my mind, I should say, that if you buy now, a year from now, with the right companies, not the ones that are still trading on dreams, you'll be in pretty good shape. So those will be higher than they are right now.
What does that mean, right companies, not the ones trading on dreams?
Well, you know, I think there are some that still have inflated valuations. I'm not going to go through them, but there are some that are clearly some more wind has come out of the sails in those. So momentum's pretty much dead now across the board. And if I look at my screen, I've just got a few that are green tickers, and I don't even know why they are. But I'd say that you can also buy stocks that have been through the wars, that because of idiosyncratic events, that they've gotten crushed, Netflix being one. So, but then again, I look at Paramount, and Paramount, even though that's taking a pretty big hit, I'm actually short small Paramount for a trading position because to me it's still overvalued with 7 times, 7 turns of debt on it. So the bottom line is you can buy now, never buy with impunity, but if your time frame's a year, 2 years, 3 years, 5 years, you're going to do pretty well. But if you're going to be anxious and worry about it, wait a little bit.